Hey guys, just wanted to make a short video about some of the changes in the world of property and investing and banking in the last 3 months. There's been a lot of things to talk about, so I thought I'd just make this quick video to discuss some of the key changes. Number one is the cash rate decision. So obviously 6 times a year we have the conversation about interest rates, and the Reserve Bank of Australia will make a decision on whether they will decrease, hold or increase the cash rate, which then has a flow-on effect to the interest rates that we pay on our mortgages, on our vehicle loans and all that type of thing. So the cash rate, there was 2 cash rate decisions in the last 3 months. The first cash rate decision in May resulted in an increase, and the most recent one in June was a hold. Now, the message from the Reserve Bank of Australia is that inflation is still too high, and they still want to sort of curb inflation a little bit. But obviously with the cost of living crisis and fuel increases, they've decided to hold, and I think they're looking to just maybe review what happens in the next sort of 6 weeks and figure out what's going to happen at that point. Now, the second, probably the most controversial change or changes came from the announcement of the federal budget, which was, I think, on the 12th of May, 2026. So the federal budget came out with some huge changes that really going to shake up the property industry. One of them, probably the most controversial one, is negative gearing. Previously, negative gearing was a way that investors could sort of be subsidized for the cost of holding an investment property. Now that is gone. So it's a little bit dearer on the cash flow to hold the investment property now. And I think the idea is to make the market more friendly to first home buyers. But of course, it's caused a lot of controversy because it made sort of wealth building, especially for the younger generation, a little bit more difficult now. There is an exclusion to the updated policy, which is new homes. And that's, of course, because it looks like the government is wanting to prioritize supply of property. So they're sort of incentivizing investors to put their funds towards new properties and new builds, and incentivizing that and subsidizing that through negative gearing as well. One of the other changes is the capital gains tax. Previously, investors of all natures, not just property investors, would benefit from a 50% capital gains discount, which basically just reduces how much tax you have to pay when you sell or dispose of an asset. And with these changes, they're looking at sort of an inflation-based approach with a minimum 30% tax rate. So what that means is that if you've had a lot of growth previously, you could have just relied on the 50% tax, 50% discount on the capital gains tax, but with the inflation base and the minimum 30%, it might be a little bit more. Again, it's something that you'd have to consult with your accountant maybe before you sell an asset, just to figure out exactly how much you'd be paying. But again, it's created that sort of disincentive for investors who are now looking to potentially hold onto their property for a while, get a lot of growth in that, and now have to pay quite a bit of that back to the government under a tax without that sort of 50% discount. The other big change was the self-managed super fund. So as part of a deal to get the budget through Parliament, Labor government and the Greens have sort of come together. And one of the things that Greens have proposed is to eliminate limited recourse borrowing arrangements, which is sort of borrowing funds in your self-managed super fund. Now, investors will know that gearing an investment can result in quite can increase your gains. It can also increase your losses. And people would use gearing for in their self-managed super fund to purchase property to sort of get large amounts of growth. Now, of course, with that now no longer allowed under sort of the new proposals, it is definitely going to shake up the property industry even more. And it's been sort of a huge slap on people who've sort of been working towards self-managed super fund property purchases as part of their retirement and wealth building strategy. So we'll see what happens. I think a lot of these changes will be conversations at election time, next election, and we'll see what all the different parties are proposing. But I think there's a lot of parties that are sort of riding the reaction of the public at the moment, and we'll see if that carries through to the next election. One thing I will mention as well, another exemption in relation to self-managed super fund borrowing, it seems to only be in relation to borrowing or gearing against residential property and not commercial property, because I know that's obviously a popular type of purchase under a self-managed super fund. Again, I think you'll see that a lot of these changes are sort of leading. I think you might find a lot of people start looking at commercial property as a way to invest because of the high yields, and also because they can sort of gear against it under their self-managed super fund and things like that. So that's pretty much the summary of everything that's happened in the last 3 months. If you want to have a quick conversation about your particular scenario and see, what's changed for you and what that means for, your future borrowing or future investment, feel free to book an appointment with me, and I'd love to have a chat about your particular situation and see what we can do.